Hello and welcome to another episode of Fractional Impact. Today we're speaking to Rachel Woolcot about how to build finance operations that don't just support growth but accelerate it, why so many companies wait too long to overhaul their systems, and what it takes to prepare a business for expansion or exit. Rachel, great to have you on. Would you like to introduce yourself?
Thank you, Stuart. Yes, well, I am a seasoned finance director and strategic partner, and I've worked for over 20 years holding senior leadership roles and been involved in finance transformations, implementations, and acquisitions. I've worked with companies that PE-backed and listed companies with revenues exceeding $100 million.
Awesome. Well, I'm excited to go a bit deeper into all of that today. We're joined as well by Gianna Maliari from the Fractional Clients team. If you'd like to introduce yourself, Gianna.
Thanks, Stuart. As Stuart said, I'm part of the team here at Fractional Clients, and I'm excited to get into everything regarding flexible finance solutions with Rachel today.
Awesome. So my first question for you, Rachel, just so that anyone listening can get a deeper sense of who you are and what you've done, tell us a bit more about the 20 years of experience that you mentioned, and also why you started Flexible Finance Solutions in the first place.
Sorry. For me, life is about sharing and growing, and that was the idea behind starting Flexible Finance Solutions. I wanted to put my experience and knowledge to have a broader impact and help ambitious companies, those which are ready for their next step, to help them grow and the people in their organizations grow, bringing them clarity, making informed decisions, and creating cohesion across the organization. That's been the idea behind Flexible Finance Solutions. My model enables me to be a strategic partner, but I've also created a community of finance professionals. And in this community, we are there to collaborate as opposed to compete, and provide our clients with expertise in different areas without having to incur the full-time cost of getting that expertise.
Awesome. Cool. Tell us a bit about the types of companies that you're working with, the positions that they're in, and ultimately what you're really helping them to do.
Well, some companies might be wanting to grow, but they might not have the strategic finance input to help them achieve the vision of the CEO. So with my input, I can ascertain what the vision of the CEO is, ensure that there is the necessary funding to support that growth, and then create a plan, create a goal across the whole of the organization. So each department has different goals, but they are all aligned to the strategic commercial goals and finance goals of the organization, and then providing that structure so that enables them to grow. Another instance is when companies think that they want to have an exit in the future, and is to create the foundations so that they can have a good exit. Without good foundations, you can't tell a real story, the story behind the numbers. You might not be sure that you are fully compliant, and that erodes value at an exit. So, and if a company wants to expand internationally, or maybe right now they are working on spreadsheets and their information is not good enough, then I will be there to help them so that they have the information, the data when they need it to make informed decisions.
Got it. Gianna, you were going to chime in there?
Well, Rachel, you sort of answered that question there. I was going to ask, when you first started Flexible Finance Solutions, what sort of companies did you initially envision yourself wanting to help? And you mentioned international expansion, acquisitions. Are there any specific sectors that particularly interested you, or is it just from your years in corporate finance?
Ideally, I want to work with companies in the professional services sector, health tech, basically companies that creative agencies and marketing companies that feel that they are ready for their next step, whether that is growing via acquisition, expanding into international markets, or exiting in the near future. Yeah.
Cool. Thank you.
How does the sort of delivery model of the business work? So when a company works with flexible finance, what does that actually look like in practice?
Well, it all starts with a business review, in which I ascertain where the CEO wants, the vision of the CEO, where the CEO wants to take the company. And I also ascertain the systems the company has in place. Where are the possibilities? Which solutions can I implement to accelerate that growth? And my model, because of the community that I have behind Flexible Finance Solutions, it means that I can not only give strategic advice, but I can also put in place operational solutions. So that it's not just advice, we can follow through execution if the company doesn't have those resources in place already.
Yeah. What was the gap effectively in the market that you were seeing that made sense for flexible finance to fill?
Well, it is basically smaller companies that up to now haven't been able to afford full-time CFO, sorry. And basically, this is giving them access to expertise without the full-time cost of a hire of that expertise.
Yeah, makes sense. What are the sort of possibilities out there that strategic finance, as you call it, can actually bring to a company?
Well, as I mentioned before, I think basically strategic finance is about making sure that the organization can look, it's not just about results, it's not just about looking at the past, but it's also about looking into the future. Is helping the leadership teams see what's possible and being an enabler, a facilitator for those possibilities. That's what strategic finance can bring.
Yeah. I know the one thing you've done is sort of showing how financial foundations can influence valuations for companies? Because you touched on that earlier about kind of, even if you're not ready to sell your company yet, there's things that you can do now that maybe 2 years, 5 years down the line will make an impact on valuation. What are those types of things that founders or C-suites can be doing now to help their future valuation?
Well, the first thing is to make sure that the foundations are right, that they can support the data, that the owners can show they really understand the business, so that the business can, so basically that investors can trust the numbers, that the numbers, that projected numbers for forecast are credible, without showing that you have those strong foundations. Credibility can be eroded at an exit, and that erosion can result in either the company, if the company has good foundations, it can act as a leverage, so that the company, it adds value, and if there are holes, because in the due diligence those become apparent, then the company ends up losing value, because the potential buyers will ask for a discount, or will ask to keep money on escrow to cover potential liabilities that might arise in future.
Yeah, I've never sold a company, so I've not been through that process. I'm curious what kind or what size of impact it can create, because I can understand that if you sell a company and you have really clean finances for the past several years, then you're going to get a better valuation than if you don't. Makes sense. But let's say in 4 years I were able to sell a company for 5 million, right? Just as a made up number. And but if I didn't have clean financials this year, I could only sell it for 4.8 million. Then I probably wouldn't care that much. You know what I mean? Because it's such a small difference in the context. So how big of a difference in valuation can it actually make?
Well, I don't think it would be a difference of 200K, to be perfectly honest. But it would be more different. The fact is that poor financials might really, really not get you even the 2 million, because there might not be the credibility for you to support those 2 million, whereas you could possibly get 5 million with good financials. That's the difference.
Yeah, interesting. And so for the companies that are maybe listening to this and they're not in a position to sell right now, but it would be an option for them in a couple of years, let's say, when you talk about getting your financials in order, what does that practically look like in terms of the numbers that a company might need to figure out? Who has to figure them out? Like, can the CEO do it? Do they need an external accountant? Do they need to bring someone in-house? What would your recommendations be there?
Well, I think it depends on the team that the finance team the company already has. And it depends on how the numbers are analyzed and the data it already has.
Yeah.
So if the data that the company has is maybe not very conducive for decision making, then maybe setting up new data so that you can back up the numbers, and maybe a different reporting structure. You can look at historical figures and maybe try to align those. If not, you can say, okay, this is the correction, at this point, and from this point on, we analyze this we've made these corrections, and then going forward, we have full set of clean data. I think it is important to be transparent. Sorry, yes, Jana?
Sorry, I didn't mean to cut you off there. I was just going to ask in particular if you've seen any examples where stronger financial clarity have resulted in higher valuations when it comes to those companies that are prepping to sell or exit.
Sure. Yes, I've seen both. You know, in one instance, the sale went through perfectly. There was clarity in the numbers, clarity in the projections. You could see that the business, the selling business, if you like, had all the supporting data for future forecasts. And from a compliance perspective, everything was good. So the potential buyers didn't have much leverage to withhold cash or to ask for a discount. Whereas in another instance, the company did have to basically reduce the price because the buying company saw pitfalls in its compliance, and it asked for money on escrow to cover those potential liabilities in future.
Understood.
In terms of financing, which I appreciate is a big kind of part of your career and your current company as well, there seems to be so many different options out there for founders in terms of financing. They can obviously bootstrap effectively. They can get loans. They can have some sort of a merger, let's say, or they can just sell the company to someone else or to private equity or whatever. How do you help companies or founders figure out what might be the right option for them, and what is the case that selling the company might make sense versus staying bootstrapped versus getting a loan versus something else?
I think it does really depend on what the CEO or the leadership team really want in future. Someone might want to, just retire in a few years' time, in which case an exit is possibly the best case. Other companies might need funding, but they don't want to lose control. That's a big thing if they were to sell to a private equity firm, or their say would be more influenced, if you like. They have to take into consideration the wishes of the private equity firm. So I think it does depend on what the wishes and the vision is of the CEO.
Yeah. Maybe it's just me personally, but I couldn't see myself getting outside investment that comes with some sort of decision-making authority. You know what I mean? Where I'm still the CEO or the managing director, but I also have to listen to some sort of board of investors. You know what I mean?
Exactly.
And I assume there must be a lot of founders in that position, or maybe they think they can, but then they actually struggle with it. I think if it were me, I would rather either just sell it outright and then I'm not part of it, or get funding where they don't have control, so like a standard bank loan, or sell it, or remain as an investor but be kind of non-exec, as they call it, and then that way I kind of can accept that I'm not in control anymore, and then I'm fine with that. But I think with finance or with CFOs, people see that as a very numbers, objective role. There's not much, or there's less human interaction or emotion or lifestyle influence than than other roles. But do you ever find that when you're speaking to founders, you actually have to get into the, you know, the lifestyle and the personal wants and needs and things like that to help determine which type of funding makes the most sense?
Of course, yes, yeah, and what is realistic, because if the founder has ideas of, say, for example, expanding internationally, and he or she wants to do it quickly, then maybe actually acquiring an entity internationally might be the best, you know, the easiest option. But clearly that's the most expensive option. And you might not, you know, you might not be able to fund that with a bank loan, in which case you do need investment. So investment in which you have to consult, you are not the only decision maker, let's put it that way.
Leading on from that, how would you deal with founders who are sort of emotionally invested in handling all the finances themselves?
Well, I think that's first of all, is about building trust. You know, for them to see that they can trust you and that they don't need to be on top of finance, that you can be on you know, responsible for the finance operations, if you like, so that they can focus on what they do best in their business. Because as the company grows, the finance side of things takes more time, and then they might actually not be running the business, but doing what a finance executive should be doing.
How you mentioned trust there. How do you build trust in a company when you're coming in, obviously initially as an outsider, when what you're working on is so important? You know, another round of funding or an exit, which of course is going to be so close to people, especially the founder or any other stakeholders in that sense. How do you build trust in that kind of atmosphere?
Well, I think it is about presenting them with possibilities and proving yourself, you know, is with your modeling, is with your suggested solutions on things that they can improve. And I think in some instances, the impact can be almost immediate. Say, for example, on cash flow, you know, you can very quickly see if there are processes that you can implement which would impact cash flow almost immediately if the company has lost sight of cash, for example.
Yeah, interesting. I know we've talked a lot about sort of funding and exits and stuff like that, but one of the things you have a level of expertise in as well is changing financial systems. What are the most common red flags or reasons that you see in companies that show that they're outgrowing their current systems and there may need a change there?
Basically, I think quite often companies rely quite a lot on spreadsheets, and spreadsheets are prone to error, and they are not integrated into the whole business. So it is very much a finance thing. Well, admittedly, even with CRMs and so on, then every department is sending spreadsheets to finance. And that is very clunky. It can serve maybe initially, but at some point, it does lead to confusion, lack of clarity, underperformance, you know. So it impacts the whole organization. That's the reason why ERP implementations are so popular. Admittedly, now there are many, with AI, there are many plugins, if you like, that are very good. It depends on which element, which side of the business it needs more, as opposed to implementing a whole ERP, because a whole ERP can take a long time. But plugins can be much quicker, and they can have they can have an impact on the business, a positive impact on the business pretty quick.
Yeah.
So if I were to start a company tomorrow, would you recommend I set up an ERP right away and implement that into my systems? Or are you suggesting that plugins and such, AI automatizations, are sufficient until you reach a certain point?
Yes, I mean, I think even if you start a company tomorrow, you might not need even the plugins, but when you reach a certain scale, then maybe the plugins might be a good solution. It depends. It depends on the business and how it needs help, how you can see the disconnect. Maybe the plugin might be able to solve the problem, but maybe an ERP would be better.
But what
an
determines
ERP is very
when a
expensive.
company?
So you wouldn't want to do you wouldn't want to invest in an ERP until you are really ready for it.
Sure, makes sense.
What kind of revenue range, and I appreciate it's going to change depending on different factors, but what general revenue range would an ERP maybe be the best time to come in?
I would say maybe your revenues are exceeding 20 million.
Right. Yeah.
Yeah.
Got it. Okay. And you touched on, or you mentioned AI. What is the most effective or efficient use for AI right now in the finance function? Because I would assume, well, I would guess as a kind of layman to finance, that there's nowhere near as much use for AI in finance as there might be in sales or marketing, for example. Are there uses for it? Where might they be?
Absolutely. So again, it depends on your business. There are AIs that help you if you process a lot of purchase orders, have a lot of transactions going through AP. So just to make sure that there's no duplication, there's the correct coding, that there's backup for every invoice, for every transaction. So basically, there are AIs that really assist and make that process a lot more efficient. There are AIs that help you just with credit collections if you want, but there's also AIs that help you with revenue recognition. So in the professional services sector, or say in construction as well, when you invoice for milestones or for in advance, and you have to recognize in a given month what the clients have used. That takes a lot of time, and now there are AIs that help you with that, also with contract management. So it does depend on your business.
Yeah. And on the topic of ERP as well, since you've implemented that in different companies, what's the key to making it stick and actually get used long term and not just become a short term thing that is very expensive and unused in the long term?
Yes. Well, I would say it is key to involve everyone in the organization in the ERP. The finance strategy is key, and making sure that everyone in the organization to know what everyone in the organization expects from the ERP. Let's put it that way, so that the ERP can be configured to meet the needs of the organization. Then there is obviously the development and testing to make sure that those needs are addressed. And processes are designed around the ERP, so that it encompasses the activities throughout the organization. And lastly, clearly there has to be good training so that everyone knows how to use it, knows how to benefit from it. So yeah, that's what I would say is what makes an ERP stick.
Awesome. At Catalyst Clinical Research, you integrated 2 acquired entities. What made that successful, and what were the things that you had to watch out for so that it wasn't unsuccessful?
Again, for integrations, it is key to involve everyone or all the departments that are going to be involved in that integration, to make sure that there is any conflicts between departments of assigning responsibility and accountability, if you like, are clearly defined. Tracking and escalating any issues promptly so that the leadership team can address those promptly. And then clearly making sure that the data from, that there is integration in the communication, the data is tested, and training again is key.
Yeah. And for growing companies, where do you find that they typically overspend or potentially misallocate resources as they're growing?
I think a common pitfall is that a company wants to grow and they put a lot of their resources on sales and marketing, but they forget about the back office and about the systems, about the resources needed to support that growth. And if there is not emphasis on those, then the service levels drop. People become disengaged, customers are unhappy, and instead of adding value through that growth, value is being quietly eroded each day. So yes, companies have to be very careful of not putting the resources, not allocating resources everywhere to support that growth.
Yeah. You supported Pricerunner through a couple of sales and, of course, due diligence processes as well. What lessons from those experiences apply to today's startups and scale-ups that maybe want to prepare for an exit?
Yeah, well, as I mentioned before, I think the due diligence process is usually very thorough, and any holes or any confusion in the numbers, if the numbers are not with good documentation, backed up with good documentation, if they are not clear, if there are compliance issues, they all come to light during the due diligence process. And any doubts erode trust. So, and lack of trust either erodes value or it can hinder a sale. In those 2 instances, the sales were successful. Unfortunately, in one of them, because of compliance issues, the value was slightly eroded.
Yeah. So for anyone that's listening to this, that's maybe thinking, you know what, maybe my finances are a mess because I've been leading them as the founder, and maybe they're not my first priority. What's the best way for them to go about actually fixing them now? The best time to fix them would have been 5 years ago, but the next best time is now. So how can they take those first one or two steps to cleaning it all up?
Well, it is basically recognizing that you need to do a cleanup.
Yeah.
And start. I mean, you wouldn't be able to. I don't think that unless you are going to are prepared to lose a lot of value, you wouldn't want to go on a sale 2 months after you've cleaned up your financials. You need to give it a few years time of showing your financials in a clean state. But you'll be able to have a story that, okay, at this point I realized I was in a mess, and from now on I've cleaned up, and you have numbers to back up your valuation.
Yeah. And when they get to that time where they're starting to look for a buyer, let's say, or they're wanting to do some sort of merger or whatever it may be, and they've not done it before, which will be very common. What would you say to those founders to expect so that nothing comes out of the blue during a process that they've never experienced before?
Well, I guess you don't know what you don't know, but you initially you would want to make sure that everything in your area is fully compliant, and anything that you know that you need to be compliant, you are fully compliant with.
Yeah.
And strategic finance can help you with ascertain those compliance issues, if you like, or compliance aspects, should I say.
Yeah. What if I'm, let's say, a marketing agency where there's next to no, compliance or next to no regulations that I can think of, at least. So I'm thinking, okay, I think on the compliance side of things, I'm fine. What should I be expecting once I get, that first interested buyer? What should I be expecting during due diligence, etc., that might be a surprise to me now?
Okay, I can think of something that, I don't know, say for example, that the company uses quite a lot of contractors in their marketing agency. And from that is like, okay, have you done everything that you need to do in respect of IR35? That is not marketing specific, but it depends on the labor force that you use and how you use it.
Yeah.
That kind of, that would come up in a due diligence, and you would want to make sure actually that your paperwork in that regard is compliant.
Yeah. That's a funny example you give, because it actually applies to us very well. We use a lot of contractors, so I appreciate the advice. So for companies that are, let's say, a bit smaller and are years and years and years away from an exit, and for me, I've found at least the smaller the company, the more malleable it is and harder to predict where it's going to be in years' time. If I was running Coca-Cola, I could probably pinpoint exactly where the company will be in 2 years. But, if I'm doing 100,000 a year, then that's a lot harder. And obviously companies of that smaller size don't want unnecessary expenses as well. When is the right time to start speaking to someone like yourself, just to make sure things like compliance, finance, etc., is in place, even when they know that they're not going to be ready for an exit anytime soon? When is that right time? Purely, and I ask for context, just so that if people are listening to this and they hear that they are that stage, then it's it's the perfect time for them to contact you.
I would say if your revenues are exceeding 1 million, ideally you want to start thinking about making sure that your finance operations are good. So with flexible finance solutions, for example, you would have access to, fractional, being very part-time, very sporadic. It might not be even once a week. It can be even less than once a week, but just to make sure that you are on the right track.
Yeah, awesome. And on that note, what is the best way to get in touch with you?
Well, you can book an appointment through my website, flexiblefinancesolutions.com, or book with me on LinkedIn, or send me an email at rachel@flexiblefinancesolutions.com.
Fantastic. Any closing questions or comments, Gianna?
No, thank you, Rachel.
Thank you. I think I guess I would like to say that remember that strategic finance is like a compass of a business. It's not just about looking to the past, but as well guiding you into the future. So yeah.
That's awesome. A great quote to end on. Well, thanks a lot for joining us, Rachel. It's been a pleasure to hear about your experience, and I think there's a lot of value and information that people can take from this. So thanks for joining us.
Thank you, Stuart. Thank you for having me.
Of course. And for the viewers and the listeners, thanks again for joining us, and we will see you in the next episode of Fractional Impacts.